Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of November the 24th, 2025. Now, to get started this week, we'll begin where we always do with that very important dollar index, or in this particular case, we're looking at the USDU Bloomberg US Dollar Bull Fund to measure this dollar strength. Now, we've been running along the T-cross long for basically about 2 weeks now, and we're starting to rise higher. Bets are mixed on whether the Fed's going to cut or whether he's not going to cut, but quite frankly, guys, at this point, it's just really a lot of noise in the market and a lot of confusion, and that's coming from the Fed members. But again, for now, the dollar index is moving up, but as we can see, the Vantage Point indicators are, the neural index is green, but the neural index strength is actually pointing down, that it's losing momentum here. So again, our MA diff cross has told us that we were going to rise, but we still remain negative on the calendar year. So when we look at it, we measure it from a hard anchor point to where we closed approximately on Friday, we can see that the dollar is still down 2.17%. Now, this is probably something you're not hearing very often because I'm not hearing it at all on the media or on CNBC, Bloomberg, these types of things. They're simply talking about the dollar's strength when in actual fact, it's still negative on the year. And historically, the US dollar does very poorly around the US Thanksgiving and more specifically in the month of December. So we could be getting near a corrective move on the dollar, but the key levels you want to watch going into next week, the monthly opening price 26.91, and of course that very important T-cross long at 26.98. Now, I think a further look at the equity markets, because again, the media really kind of spinning things both ways here, but let's look at some true performance here on the SPYs, which mirrors the S&P 500. So from the low point back in April, we've rallied a massive 43.15%. That's from the lows that they continue to cherry pick. Now we're going to delete that. Now we're going to say, okay, when we moved above the calendar yearly opening price, how much did we rally from there? Well, guys, we rallied another 16.88% from the calendar yearly opening price back in May, which took us all the way up to the October high, which October 29th, or excuse me, October the 29th high right there. And that's coming in at about 689. So when we look at that, we want to make sure that we look at true performance here. So again, when I look at where we're currently at from the most recent low point in the market, which was on Thursday, again, we were still, what the market fails to mention, the media, excuse me, is that we're still up a whopping 10.4% on the SPYs this calendar year. And of course, we've had a massive rally on Friday on this particular ETF and on the S&P 500 futures. But in my respectful opinion, historically speaking, over the last 5 years, about the 2310 mark on the S&P 500, on a couple of different indexes, excuse me, they're showing very, very strong support down there. Now, obviously, I've got that number wrong. What I meant to say was around 6510 is the historical lows on the S&P, and we did take a very strong bounce out of there on Friday based on seasonal patterns. Again, in most cases, the S&P 500 has closed above its open price in the month of November. So we've had a powerful rally on Friday. Again, a lot of confusion around the Fed. The NVIDIA earnings were very good. The CEO of NVIDIA said he doesn't believe that there's a tech bubble here, or an AI bubble, excuse me. So the market still pushed it lower. But again, anything around the US Thanksgiving often sees this kind of volatility, which I would have expected next week. But again, the market very jittery here. But I would say, based on this, I would be looking for some type of continuation on here going into next week, providing the Fed stays in check. But you can see a closer look at that right there, this big move down, this big bar down, and then we've reversed. So again, the neural index, in my respectful opinion, the neural index strength was already giving a warning sign that this market was not as structurally weak as what it looked. Now, what we do want to see is it get back up above its quarterly opening price and ultimately get back above the T-cross long at 669.28. Now, when we do a comparative analysis to the DAX, now again, when we look at the DAX, in the month of November, we've dropped 4.53%. That automatically people think that the bears are now in control of this. But guys, the average drop in the DAX futures contracts in the month of November in the last 5 years has been just a little over 2%. I double checked the 13-year lows on the DAX on a percentage basis, and that came in at about 4.5% on the DAX futures. And I find it very interesting that that is exactly where we bounced from. And I warned everybody this week. I did get a comment from my good friend from Germany. Here come the bears. And my comment was, watch out for a bear trap. And sure enough, that's exactly what was sitting there. But again, knowing these historical levels of what this has done over a longer period of time, only in the month of November, what often happens is we commingle weeks and months together and it causes distortion. If I look at the primary trend on the DAX in 2025, I believe that this is probably one of the best years the DAX has had. And it's certainly been a very good year for the Euro too, with the DAX currently up 27.3%, grossly outperforming the S&P 500. So yes, we could have some more room to the downside, but just that little bit of information to help my friends overseas that 4.53% is a very unique number from a percentage basis. And in all those years, it didn't matter where we started the month because we always use the same anchor point, the monthly opening price. And from the monthly opening price over the last 13 years, what I can tell you is the biggest drop has been in the DAX futures about 4.3%. So very interesting stuff here, guys. Doesn't mean that this won't crash next week, but it will be dictated by the US equity markets if they can move higher. Now, looking at gold again for this particular week, then we can see that gold is basically running flat, but in most cases, not all, but in most, gold and silver do usually quite well in the month of December. So again, we're holding above that very important monthly opening price at 401.60. And I would argue also here that with gold, we would watch the VIX very, very closely, because if the VIX starts failing, that actually could potentially drag gold back down with it. But either way, the VIX is holding above the quarterly opening price, but still negative on the year. And I think this is what is being missed in the media because they're consumed by short-term trading. So if we look at how the VIX finished on Friday, based on a percentage from the calendar yearly opening price, the VIX is hardly bullish here, guys. It's down 17.85%. So I would need at the very least, to stay above the long predicted in the T-cross long, but there's already cracks in the dam on this VIX right now as it's pointing down. But a lot of this will come down to what the Fed does. Is he going to cut or not? But remember, over the last 5 years, 10 years, 15 years, the Fed has hiked, he's cut, he's been hawkish, he's been dovish, and ultimately the equities have gone higher. So that is something to think about here. And the VIX is still grossly negative on the calendar year on this particular ETF. But it is something we definitely want to keep an eye on. But I believe that either way, that the Fed is going to discuss rate cuts in 2026, and he is likely going to be cutting, but the U.S. economy is moving along pretty good by the numbers, despite the tariffs and everything else. Now, when we look at Bitcoin, Bitcoin is going to be fueled. If those equities can turn higher, more specifically the Qs, the NASDAQ, that will help Bitcoin also turn around. But again, my concern, as I've discussed on here for many, many months, that the Bitcoin has a 3-year cycle. 3 years up, 1 year down. 3 years up, 1 year down. We're in the 3rd year of the 3-year rally, which points to a pullback next year. That pullback will left to be seen because we have to first assess how we finish the calendar year of 2025. And then we'll use that new yearly opening price to gauge whether Bitcoin is going to continue to follow this 3-year cycle. And again, right now it appears likely, but if equities can turn around and we get a risk-on environment, then Bitcoin should climb higher. But the indicators for now are still negative. But right now, the key level you want to watch is 93,804. Another way of playing this particular move is putting a buy stop just above that level. And if Bitcoin turns around and gets back up above that calendar yearly opening price, we are going to rally higher. But if we can't, then it will confirm that we are going lower into year end and likely lower into next year. Looking at oil on the commodity side, I would have expected a little bit more of a bounce on this one, but again, not really the time of year to be buying light sweet crude oil. Nat gas usually should remain firm for a few more weeks, but January nat gas starts to fall off, and then we start looking at oil again. So for now, oil remains structurally weak below its calendar yearly opening price, the quarterly and the monthly. Really nothing at the current time that's overly bullish in oil, but might help if the equities turn around, could pull oil up a little bit. But again, I think I would be looking at into January, February, March for those oil long trades. Now, as we get into some of our main Forex pairs, and again, it's going to be another very interesting week in the Forex market. And I believe all eyes are going to be on the Euro-US pair. So what I've been looking at here is how we're running along this channel, basically pretty much sideways for a couple of months now. A little bit on the upside, a little bit on the downside. So there is verified support down at the low about 114.65, I believe. But again, historically, seasonally speaking, in most cases, the euro doesn't do too bad in the month of December, but it's not based on euro strength. It's based on US dollar weakness. And the euro has had a very high intermarket positive correlation to gold. So if gold can rebound, that should help pull the euro back up. I am seeing a warning sign with the neural index strength. Starting, again, you can see a red neural index, but inside that neural index, it's actually looking like it's trying to turn around here. So again, watch this one very, very closely around that monthly opening price, 115.31. If we can hold above that next week, then I believe you've got a long trade here. But either way, we'll be watching this one in December. Now, the U.S. Swiss franc, again, the Swiss National Bank, again, talking about really promoting negative rates to weaken their currency. Historically, every time they've done this, it's the only one worse at doing this is the Bank of Japan. Both have created a mess for themselves, but the Swiss bank is nowhere near as bad as Japan, which I'll talk about more in a minute here. But for now, this is basically a make or break area for this pair. The dollar and the dollar index, the USDU, UUP, they all have to move up if this pair is going to move higher, but you can see we are very negative on the calendar year. Again, another bad, even though the US dollar has done very well in the last 2 quarters, this pair remains heavily down. And again, when you have a solid anchor point in your trading, you can better assess what the real trend is. This is down 11%, guys. Currencies don't often go down this much in a calendar year. So the general, and this is probably what's making the Swiss National Bank nervous. And when they start talking intervention, well, I believe their track record speaks for itself, and I'll just leave it there. Giving the euro Swiss franc is a perfect example of how when a central bank gets involved in the market, they just make a much bigger mess. So for now, if we can get above the monthly opening price and hold above that, we may have a trade. Momentum is, I will concede, momentum to the upside is building. But I also believe that that would be short term. Now, the British pound US dollar, I know a lot of us want to get long on this thing, guys. Maybe December is our month, but we just cannot get through this very, very powerful Vantage Point predicted moving average, the T cross long. That is 131.90 back into here. So the current T cross long is 131.60. If we can get above the monthly opening price and break above the T cross long, we've got a long trade. So another way to play this is simply put a buy stop order above 131.60 is what I would suggest. And then if it does break this level, we'll be sitting there waiting for it. But if it can't get through that area, guys, the pressure is still mounting to the downside. Now, again, the neural index strength is pointing to the upside. There could be a long coming on this, and it could be as early as next week. If the Fed chatter gets more dovish, then maybe we'll get that long trade, but that wouldn't be on British pound strength. It would be on US dollar weakness. Always remember that, guys. Now the pair that that everybody loves to hate, the dollar yen. So the dollar yen, again, guys, I will be full disclosure. I am dumbfounded that this thing has made it back up to the calendar yearly opening price, but at the same time, it's a very good opportunity for me to speak to why this level, the calendar yearly opening price, is so important. We've been stalled on here for 3 days in a row. The Bank of Japan is on the hunt. Be careful around the opening on Sunday night, guys, because again, this is an outlook, not a recap of something that's already taken place. I suspect they're going to try and make a move very soon to strengthen, the yen currency, because if we break through this yearly opening price of 157.28, they're going to go into full-on panic mode and say, oh boy. But remember, they're the ones that caused this in the first place, not the Fed. The Fed hiked rates, yes, but the Bank of Japan was the one that was verbally intervening back in 2020, and they've been getting crushed since. Now their exports are doing obviously, Japan's exports are doing very well, but their imports, it's costing them a fortune with a yen this week. So just a little bit of advice here. I believe that Vantage Point is picking up on what I'm thinking. The MA diff has crossed to the downside. The neural index is pointing down. The predicted RSI is pointing down. We're failing at the yearly opening price. If there's going to be intervention here to strengthen the Japanese yen, we could be a matter of days away from that. So if you're not sure, guys, stay away from this thing. It's going to be volatile into the end of the calendar year. But I'm getting the feeling that because they're starting to talk in Japan, I believe they're getting ready to make a move on this very soon. So be very careful, okay? Now, the U.S. Canadian pair, again, it's not about Canadian strength. It's about U.S. dollar strength or weakness. Canada's come through its first budget, probably one of the most disastrous budgets I've seen. The fiscal anchor has been removed. Not even Justin Trudeau would remove that fiscal anchor of debt to GDP. Carney's budget, it's been removed. So that basically he's saying he's going to spend, and he's going to fire up those printing presses. That the very definition of a weakening currency is expanding the money supply. So this is not an elbows up issue here, guys. This is an issue that, look, this guy's dangerous. So for now, the pressure is mounting to the upside on this particular pair. And even if the US dollar does weaken, I don't think that will strengthen the Canadian dollar to any extent. I will give the new Prime Minister time to sort out things, but we're not off to a good start here. They barely got the budget passed. And the key thing and the parliamentary budget officer spoke twice on this issue. Why is the media not talking about him removing that fiscal anchor from that budget? So again, we know that central bankers love to gamble, and that's what he's doing with the Canadian economy. So for now, longs on the Canadian dollar are not recommended until such time as we see what happens with the trade tariffs, and more specifically now, this bizarre budget of his without a fiscal anchor, meaning he just thinks he can do whatever he wants. And we've seen other countries do that, and we know the outcome. So for now, biased is to the upside while above our T-cross long, and that's at 140.41. Monthly and yearly opening prices, we're still negative on the year on the pair, but positive on the quarter and positive on the month. These are critical levels down to 139.20. The only time I would be on board with shorting this is if I break below the 139.20 area. Now, if the equities can move up next week, you've definitely got a long trade on Aussie US and New Zealand US, but heavily tipped to the Aussie. So once again, when we look at these things, we have to make sure we're looking at what the real trend is. 61.98 is the calendar yearly opening price. You can see the Aussie had a real good rally on Friday, and that's because the stock market did, guys. So if you're trading Aussie US and New Zealand US, you actually are indirectly trading the S&P 500, in my respectful opinion, based on the highly correlated markets. I would say the correlation between the Aussie and the S&P 500 is sitting at about 90%. So if that stock market starts going up next week, the Aussie is going to climb with it. And again, we're still below our T-cross long. We've got to get back up, but I think a retracement, if nothing else, back up to the T-cross long at 65.06 is in the cards. Because what I will mention here also is there's a very strong seasonal level right around 64.19. So as long as you're holding above 64.19 on this pair, longs are definitely in play. And the same thing would apply to the New Zealand dollar. Now, I think the market's, again, really obsessed with interest rates in New Zealand. And yes, we're pressuring that yearly opening price. But in my respectful opinion, looking at the high correlation between Aussie US and New Zealand US, this one would be, I would consider to be better value, right? The Aussie could have room to fall, and this one has more room to rise. But based around that yearly opening price of 56.05, if we can hold above that, guys, you got a long trade and potentially a very good one going into 2026. But my only concern is we already had one failure. And this yearly opening price, 90%, 95% of traders will never even see it. It's one of the strongest tools, price-based tools you'll ever have. So if we can get above that and stay above it, then again, we will have a good long. But I think a retracement, if nothing else, back to the T-cross long, 56.59, that is likely in the cards next week. But what can undo a number of these positions is a stock market that continues to crash. So again, another volatile week is coming. I personally believe most of the volatility is out of it. I would have expected it on Tuesday or Wednesday of next week, closer to that US Thanksgiving. But I think right now the media scared everybody with AI bubble and all this other stuff. But guys, if you know your levels, trading will always be easier than listening to the media. So with that said, this is the Vantage Point AI Market Outlook for the week of November the 24th, 2020.